Good afternoon. It's Jeffrey Christian coming to you from CPM Group in New York. It's just afternoon on Friday, September 4th. The precious metals prices have come off a little bit. They're treading water there. We wouldn't be surprised to see a little bit more weakness in the coming week, just as some short-term investors take profits. But we do think that over the next month, 2 months, and 4 months, that the political and economic environment will probably lead investors to buy more precious metals, gold and silver especially, and that the prices will probably rise as we've been saying they would. I have 4 charts here today, and they concern investment demand and they concern central bank demand for gold. I'm showing you them. These are charts that will appear in the September 10th Precious Metals Advisory. CPM Group produces a precious metals advisory on a monthly basis, covering gold, silver, platinum, palladium, and rhodium. And these are charts that will appear in next week's issue. There is a lot of bullishness in the market, and there's a lot of reasons to be bullish in the market. We have seen investors start to buy precious metals, physical precious metals, in greater volumes than they have at any point since 2016. 2017, 18, 19 were kind of weak. And we've seen investors start to buy back some gold and silver as well as some platinum this year. The bullishness is accompanied, the rational bullishness is accompanied by some perhaps ill-placed bullishness. And there may be too much bullishness in the market at present. That said, as I said, we think the next 4 months are going to provide ample opportunities for investors to make profits by being long on the upside. But one of the things that you'll see, and 3 of the charts here point to it, a lot of people look at gold and silver exchange traded fund holdings as a surrogate for investment demand. CPM Group does that too. And in fact, most of this metal that you see here happens to be investors buying gold and silver through ETFs because they prefer that medium for investment to something else. We see here, if you look at the first chart on the upper left-hand corner, this is gold year-to-date additions of gold to physical ETFs. These are not the leveraged ETFs that don't buy physical gold. These are ETFs that buy physical gold and hold it in typically allocated holdings so that it's not mobilized by banks. Through August, it's about 27 million ounces. That's more than in any given year prior to this. The chart on the upper right side is silver ETFs, same thing, and it's over 300 million ounces. That's an incredible amount. In 1980, when the price of silver went from $3 to $50 and then back to 16, investors bought about 220 million ounces. They got close, about 197 million ounces in 2011, but they have never in history bought 300 million ounces of silver in a year. There are some people who have bad data that suggest that, but they're wrong. Investors have never bought 300 million ounces of silver in a year, and they probably haven't in the last 6 months, 8 months. This data goes through August, but this the purchases were in 3 or 4 months in the first half of the year. What we're seeing in both of these instances is that market makers, banks and dealers who trade gold and silver as market makers, they stand ready to buy or sell if their counterparts want to sell or buy. Market makers have taken in a tremendous amount of gold and silver in the first 6 months of this year, and in fact, over the last 3 years. As I said, 17, 18, 19 saw very low investment demand, and a lot of investors actually on a gross basis were selling. And when they sell, a lot of that metal is sold in the spot market in London. And as a result, you see record amounts of gold, silver stored in London, Zurich, and New York. Inventories in the major Western market centers have never been as high as they are now. Silver actually peaked in March, and we saw about 84 million ounces of silver come out of London vaults in March, between March and July. COMEX stocks rose 19 million ounces. That leaves about 64 million ounces of silver that is unexplained. Not quite sure where it went. Some silver, not that stuff, but some silver and gold went into the ETFs. And what we have realized is that market makers, the bullion dealers and banks that trade this stuff, seem to have taken some of the gold and silver that they bought over the last 3 years and over the first 6 months of this year, and they have traded some of that gold and silver in for shares of ETFs. So they will go to the managers of the ETFs, say, I have gold, I want ETF shares. And that gold transfers from the bullion bank's holdings to the ETF holdings. A lot of times the gold doesn't move because it's all in the same London vault or New York vault. And the same is true with silver. So we're seeing these enormous numbers that seem to suggest that investors have bought historically high levels of gold and silver via the ETFs in the first half of the year. Investors clearly bought a lot of gold and silver in the first half of this year, but they clearly didn't buy as much as the ETF holdings show. We're working trying to disassemble that amount and come up with fair estimates as to how much of it was investment demand and how much of it was market makers swapping physical metal held in London or New York for ETF shares. And we hope to have some information in next week's Precious Metals Advisory as we scrounge around the world for information. So that's that. The bottom left-hand chart is central bank gold. Purchases and sales, the red stuff is gross sales in a given month that are reported, and the yellow stuff is gross purchases. And what we've seen over the first 7 months of the year is that a lot of central banks have pulled back sharply from buying. If you look at the last several years, Russia, Kazakhstan, China, and then in the last couple of years, Turkey, India to a lesser extent, have been the major buyers. You had maybe another 10 to 20 central banks that were buying small amounts, but the vast majority of the gold that was bought over the last 10 years has been from Russia, China, and Kazakhstan. And those three countries actually pulled back from the market. Kazakhstan was a seller in the first half of this year. They bought a little bit more in July. They bought a little bit back in July. But what we saw in the first half of the year was that 6 of the 7 million ounces of gross purchases by central banks came from Turkey. The Turkey Central Bank has been buying gold for the last several years. It has sanctions against it from the US. It has hostile relationships with the EU. It has extremely hostile relations with Russia. It has a civil war across its southern border in Syria. It's got the Kurds issue that it has chosen not to resolve for 100 years. It has refugees from Syria, Iraq, and Iran pouring into the country. Turkey has a lot of issues. And what it has been doing is converting its dollars and euros into gold. And Turkey has been the major buyer in the first half of this year and in the first 7 months. It bought about 2/3 of the gold that was bought in July. Kazakhstan, as I said, bought a little bit more. Uzbekistan and Mongolia were selling, probably needed some foreign exchange. So what we're seeing is the price elasticity of central banks. Central banks are much more price sensitive than private investors. And when private investors bid the price of gold up, the central banks pull back. When investors don't want as much gold, then the central banks will take the opportunity of lower prices to buy more gold. And we're seeing that a lot of central banks have backed away from buying gold. And Turkey, which has specific political and economic issues, has been the major buyer by far in the first part of this year. That's the view here. We're going to get back to work on the Precious Metals Advisory so that we can get it out by next Thursday. Have a good weekend, and we'll talk to you next week.